One company quietly manages more money than the entire economy of Japan. It's called BlackRock, and it oversees more than $11 trillion, largely through something you've probably clicked buy on without a second thought, the ETF. Here's the part that should stop you. BlackRock doesn't need your ETF to go up in value to make money from you. It gets paid whether the market soars or crashes, quietly skimming a sliver off your account, year after year, for as long as you hold it. Most investors think they're just buying a basket of stocks. What they're actually doing is signing up for a subscription they never read the terms of. This video is going to show you exactly how that subscription built some of the most powerful financial companies on earth. ETFs were sold to the world as the great equalizer. Cheap, simple, diversified investing for everyday people, instead of just the wealthy. And in many ways, that promise was real. But somebody has to run these funds. Somebody builds them, manages them, and collects a fee for doing it. By the end of this video, you'll understand exactly how that fee turned 3 companies into the largest shareholders of nearly every major business in America, why the fee war between them looks like generosity but is actually a brutal survival strategy, and why owning the company that manages the ETF has often been the smarter trade all along. Imagine you want to invest in the stock market, but you don't want to pick just one company. You want a little bit of everything, spread across hundreds of businesses at once, so no single failure sinks you. Buying each stock individually would take forever and cost a fortune in transaction fees. An ETF solves that instantly. Picture a fruit basket assembled by someone else. Instead of walking through the grocery store picking out one apple, one mango, one orange, you just grab the whole basket in one motion. Someone already did the sorting for you. That's an ETF. One purchase gives you a slice of hundreds, sometimes thousands, of companies at once. It sounds almost too convenient to charge for. But someone has to build that basket, restock it, and maintain it every single day the market is open. And that someone gets paid. Here's where it gets sneaky, in a completely legal, fully disclosed way. The fee charged by most ETFs is so small, it's measured in something called basis points, hundredths of a percent. A fund charging 8 basis points is only taking about 8 cents a year for every $100 you hold. It feels like nothing. That's exactly the point. Picture a landlord who charges each tenant in a massive apartment building just $1 extra a month. No single tenant would ever complain. But that same landlord owns 50,000 apartments. One quiet dollar, multiplied by 50,000 units, becomes an enormous, steady river of income, and almost nobody feels it happening. Stretch that same tiny fee across $11 trillion, and even a fee measured in fractions of a percent turns into billions of dollars a year in pure revenue, collected automatically, without BlackRock or Vanguard ever having to convince you to do anything after your first purchase. Here's the plot twist that confuses most beginners. If ETF companies profit from fees, why have those fees been collapsing for over a decade? Back in 2010, the average equity ETF charged about 0.5% a year. Today, that average has fallen to roughly 0.08%, and some of the largest funds charge as little as 0.03%, practically free. This isn't generosity. It's a price war, and it works almost exactly like a razor company giving away the razor handle for nearly nothing, because the real money comes from something else entirely, in this case, sheer scale and everything that scale unlocks. Whoever offers the lowest fee attracts the most money. Whoever attracts the most money becomes too big for rivals to compete with on price alone. Vanguard built its entire identity on this strategy, becoming famous for razor-thin fees. Then something remarkable happened. BlackRock, a company built to compete with Vanguard, started cutting its own prices just as aggressively, sometimes even lower, turning what should have been a stable industry into a permanent price war with no finish line in sight. Here's the twist that most people, even regular investors, have genuinely never stopped to think about. When you buy shares of an S&P 500 ETF, you're not just buying stock. Somebody has to actually hold the underlying shares of every company inside that fund, on your behalf. And when you multiply that across millions of investors, something strange happens. The ETF companies themselves end up holding, and voting, enormous blocks of stock in nearly every major company in the world. Picture 3 landlords who, between them, own a piece of almost every single building in an entire city, not because they run those buildings day to day, but because millions of small investors each own a tiny slice of the landlord's investment funds. BlackRock, Vanguard, and State Street, together known simply as the Big Three, now sit among the largest shareholders in roughly 96% of S&P 500 companies. They rarely make headlines for it. But when it comes time to vote on corporate decisions, executive pay, or major mergers, these three quiet giants often hold more combined voting power than any single activist investor or founder ever could. Nobody voted for this kind of influence to exist. It emerged, quietly, 1 basis point at a time. This is why, for an ETF company, growth isn't just nice to have. It's existential. A fund with $1 billion in assets, charging a tiny fee, might barely cover its own operating costs. The exact same fund with $500 billion in assets, charging that identical tiny fee, becomes a cash-generating machine, because the cost of running the fund barely increases while the fee revenue scales up enormously. Think of it like running a massive warehouse. The cost of keeping the lights on and staff on payroll stays roughly the same whether the warehouse is half full or packed to the ceiling. But every extra pallet stored inside is almost pure profit. That's why ETF companies obsess over asset growth above almost everything else. Size isn't a vanity metric. It's the entire business model. But here's the uncomfortable question hiding underneath this entire industry, and it's worth sitting with. If BlackRock, Vanguard, and State Street collectively become the largest shareholders in nearly every major company on Earth, who's actually making sure those companies compete against each other properly? Some economists have raised concerns that when the same handful of giant shareholders quietly own stakes in every airline, every bank, or every pharmaceutical company at once, the incentive to fiercely undercut a competitor's prices might quietly soften, since profits flow back to the same small group of owners either way. There's also a structural risk hiding in plain sight. Even something as simple as picking which ETF tracks the same index can matter. The oldest S&P 500 ETF, built decades ago under older rules, can't reinvest dividends or lend out its holdings the way newer competing funds can, quietly costing long-term holders a small edge every single year, compared to newer versions tracking the exact same index. None of this means ETFs are secretly dangerous. For most everyday investors, they remain one of the cheapest, simplest ways to build wealth ever invented. But the same quiet mechanics that make ETFs so convenient for you are the exact mechanics that made a handful of companies more powerful than most governments. So here's what 30 years of ETF growth actually proves. The safest, most reliable fortune in this entire story was never built by picking the right stock inside the basket. It was built by owning the company that wove the basket in the first place, and got paid a small fee every single day, rain or shine, boom or crash. It's the same pattern you'll find underneath casinos, toll roads, and crypto exchanges. The businesses that win most consistently over decades are rarely the ones making risky bets. They're the ones collecting a tiny, repeatable toll from millions of people who are placing the risky bets themselves. So here's the real lesson sitting underneath every ETF you've ever bought. The fee looks too small to matter. That's exactly why, multiplied across trillions of dollars and millions of investors, it became one of the most powerful business models in modern history. And here's the question worth thinking about. If 3 companies quietly become major shareholders in almost every business you interact with every day, does it still make sense to think of the stock market as thousands of separate, competing companies, or has it quietly become something closer to one giant, interconnected machine, owned by a surprisingly small number of hands? Do you think that much concentrated ownership is a problem, or just the natural result of everyone wanting the lowest fees possible? Let me know in the comments.